What is mortgage protection life insurance? This is a question that's commonly asked by homeowners, individuals looking to get life insurance for their mortgage, and just everyday citizens are looking to figure out what exactly is mortgage protection life insurance. And in this video today, I'm going to be breaking down exactly what it is, where you can get it, why it works, and why it's even called mortgage protection life insurance in the first place. As always, please make sure you guys like, comment, and subscribe, and let's hop right into the video. All right, let's hop right into it. So what is mortgage protection life insurance? My name's Trey. I'm the owner of Agent Lead Lab. I've been a life insurance agent for over 5 years now. And so I'm going to be breaking down what is mortgage protection life insurance, because a lot of people do ask and want to know whether you're a homeowner, whether you just heard the term, or you're just searching online and trying to figure out exactly what it is. I'm going to go over it briefly today. So mortgage protection life insurance is literally just life insurance used to pay off or protect your mortgage. Okay. It can be whole life, it can be term life, or it can be index universal life. Now let's go through each of them briefly, and this will not be a long video. Okay. So for term life, right? Term life means it lasts for a term. So it could be 15, 20, 25, or 30 years. Sometimes they have 10-year terms. Sometimes they have 35, 40-year terms, depends on the companies, but 15 to 30 is typically your standard. This is the most common way when people say mortgage protection to protect your house, because what happens is, let's say you have a $500,000 house, you can get $500,000 of coverage. And let's say your term or your loan is for 30 years, you get it for 30 years. Super simple. Now there's all sorts of different combos in between. You could be at 15 years in your term, 10 years left, 5 years, and you'll get with your life insurance agent to see what option works best for you. But understand that you should be allocating a budget towards having mortgage protection, because it is there if something does happen. It also pays out in the event of chronic illness, disability, and obviously if you pass away. Some of them also come with what is called living benefits, essentially meaning that, or cashback options, I apologize. Those are living benefits. Cashback options meaning that at the end of the term, you can get your money back. So it's almost like a savings account without the interest that you may potentially gain. But the benefit to this is it protects you in the event that something does happen. It's kind of like having car insurance, except for it's for your life, right? Now, this is the most common only because it's very simple to explain and it's typically cheap, right? But you do have to be in pretty good health. So if you're younger, highly recommend you getting mortgage protection if you just bought a house or you're a newer homeowner. Now, you can pay off the entirety of the mortgage, or you can pay off a partial amount. So when you get older, you're like 50 years old, maybe 60 years old, and you got a home, it's going to be really expensive to cover. A lot of companies won't even give you 30 years or 20 years. So they only give you 15. So you're going to cover the majority of the time that you have left on the loan in the event that something happens. The second option is going to be leveraging whole life. Okay. Now this would be a smaller policy. So let's say you still have that $500,000 house, but now because of your age or because of any health conditions that you may have, you can't get the entire house covered because you can't get term, right? Your health doesn't allow you to qualify. Your age is too old, right? The insurance company will not insure you. At this point, you need to start focusing on going for a smaller policy to protect the equity in the home. Now, what do I mean by that? I keep using that word. So let's say you get $30,000 of coverage. You're like, wait, my whole mortgage is $500,000. What do you mean? Okay, well, we need to figure out what are your monthly mortgage payments. Let's say your monthly mortgage payments are $1,000 a month, right? Just use that. We know that if we get $30,000 of whole life, we get mortgage payments for 30 months, right? Which could be a little over 2 years. Now, typically, mortgages could be $2,000, $3,000, $4,000, $5,000. So you start doing the math based on how much coverage you can get approved for and what fits in your budget. The purpose is you want to get anywhere from, 3 to 12 months of mortgage payments, so that way you can sell your house. So although you may be thinking, well, what if I just sell it? Well, it doesn't always work like that. Selling a house takes time, right? You got to get up on the market. You got to get it for a good price, right? You need to make sure that the agent that you're working with can actually, sell the house. The buyer may pull out. There are so many different things that go in. Most people just say, oh yeah, I'm going to put my house up and somebody will buy it. Well, yeah, but do you want to sell your house for significantly less than what you put into it or what it's actually worth? And then most people say no, right? So you want to be able to pull the equity that's been built up out of it. You don't just want to sell it and not really get any of your money back. If not, you want to gain some money, especially if you've been paying on the house for a long time. So you get these mortgage payments to protect the equity that's in the house, right? And that is the whole entire purpose of leveraging a whole life policy. It's not to try to pay off the entirety of the mortgage. That's very backwards, right? So this is for older individuals that if you're watching this, or if you are figuring out different ways to leverage life insurance, or you've heard mortgage protection, it's otherwise known as equity protection or asset protection. A lot of different verbiage that you use. Essentially, you are just trying to buy time. The last option is leveraging an index universal life insurance plan. And this will also still cover large amounts, 100,000, 400,000. $50,000. It's not as affordable as a term, and it is still pretty difficult to get qualified for, but there's built-in cash value and market participation in the S&P 500. So you're still able to, as long as it's structured properly, receive the benefits of that as well. Now, this is also a great option because it's going to last with you, right? It's not going to be for 15, 20, or 30 years, right? You're going to pay on it. It'll still be a life insurance policy. And depending on how it's structured, you may get payouts. You may be able to receive money at a certain point in time. So you'll want to get with the specialist so they can break down exactly how to use that. But I hope this video was really quick and straight and to the point. I think every homeowner should consider getting it just because one of those three is going to be useful for you. You know, you could be younger and still do the whole life plan and just get whole life insurance, right? And get a $50,000 policy for whatever it is per month. You could get an IUL, you could get term, but I think just having life insurance in general is great. I think a lot of people don't necessarily know what mortgage protection is. So they're always questioning it. So I hope this video helped. As always, make sure you like, comment, and subscribe, and we will talk soon. All right.